Every day, someone spends less than $5 and creates their own cryptocurrency. No coding, no team, no permission. Just a name, a ticker, and a picture. And every day, someone else spends $50,000 on machines just to mine a single Bitcoin. Two completely different price tags for the same word. Owning a cryptocurrency. So which one is real? Is crypto ownership a $5 hobby or a $50,000 business? And when your wallet says you own a coin worth $1 million, does that money actually exist anywhere? By the end of this video, you'll know exactly what it costs to create a coin, mine a coin, and why almost nobody who owns a cryptocurrency ever gets to touch the number they see on their screen. So back to the question from the start. Is owning a cryptocurrency a $5 hobby or a $50,000 business? The honest answer is both exist, and they're not the same thing at all. One is closer to running a small factory. The other is closer to buying a raffle ticket with better marketing. If you're someone thinking about getting into crypto, the real question to ask yourself isn't, how do I own a coin? It's which of these three games am I actually playing? Are you paying for real production costs like a miner does? Are you creating a token and hoping attention turns into liquidity? Or are you buying someone else's token, hoping there's a bigger buyer coming after you? Knowing which game you're in is the difference between making an informed bet and mistaking a number on a screen for money in your pocket. If this helped you understand crypto ownership a little better, subscribe, because we break down exactly how these financial systems actually work. Let's start with the biggest lie in crypto. Not a scam, not a rug pull. Just basic math that everyone reads wrong. You've seen it. A coin is worth $2 billion. People call the creator a billionaire. But here's what market cap actually is. The price of the last trade multiplied by every coin that exists. That's the entire formula. Last price times total supply. Say a coin has 1 billion tokens in circulation. Someone buys just one token for $1. That's the last trade. Multiply $1 by 1 billion tokens. And suddenly the coin is worth $1 billion on paper. But only $1 actually changed hands. This is why market cap is not money sitting in a bank account. It's not money at all. It's a projection based on the assumption that if everyone tried to sell at once, they'd all get the same price as that one lucky trade. They wouldn't. The moment big holders start selling, the price crashes with every single sale, because there aren't enough buyers on the other side to absorb billions of dollars of selling. This is called an illiquid market, and almost every cryptocurrency you've heard of that isn't Bitcoin or Ethereum lives in this zone. A handful of wallets hold most of the supply. A tiny fraction of that supply actually trades on any given day, and the market cap number is built entirely on that tiny fraction. Here's a number that makes this real. On Solana's Pump.Fund platform alone, over 11 million tokens have been created since January 2024. The platform itself has made more than $750 million in fees from people creating and trading these tokens. Think about that. The house made $750 million. Most of the people who owned those 11 million coins made nothing, because most of those coins never had real buyers behind their price. So when someone shows you their wallet and says, "I own $50,000 of this coin," what they actually own is 50,000 tokens multiplied by whatever the last trade happened to be. Whether that $50,000 is real depends entirely on whether there's someone else willing to buy those tokens off them at that price. Most of the time, there isn't. This is the first thing to understand about owning a cryptocurrency. The number on your screen and the money in your pocket are two very different things, connected by a bridge that can collapse the moment you try to walk across it. Now, if market cap on paper isn't the same as real ownership, what does actually cost real money to create or earn a coin? That's where it gets interesting, because there are two totally different paths, and they cost wildly different amounts. By the end of this video, you'll know exactly what it costs to create a coin, mine a coin, and why almost nobody who owns a cryptocurrency ever gets to touch the number they see on their screen. The first path to owning a cryptocurrency is mining it. And mining is not free money from a computer. It's a manufacturing business. And like any factory, it runs on raw materials. For Bitcoin, The raw material is electricity, and the factory is a specialized machine called an ASIC, built for one job only, guessing numbers as fast as possible until one of them matches what the network wants. Here's what that factory costs to run in 2026. A single modern ASIC machine costs between $3,000 and $8,000 to buy. That machine then runs 24 hours a day, consuming as much electricity as several houses combined. Industrial mining operations, the ones running warehouses full of these machines, pay between $32,000 and $55,000 in electricity alone to produce one single Bitcoin. Add in the hardware, the maintenance, and the cooling systems, and some estimates put the true all-in cost of mining one Bitcoin above $70,000. To put the electricity cost in perspective, mining one Bitcoin today uses around 850,000 kilowatt-hours of power. The average home in the U.S. uses about 10,000 kilowatt-hours in an entire year, so mining a single coin burns through roughly 85 years' worth of one household's electricity use. And here's the part that kills most people's dream of mining from home. Industrial miners pay around 7 to 8 cents per kilowatt-hour for power, because they negotiate massive bulk deals. Your house pays 16 to 20 cents per kilowatt-hour. At that rate, running a mining machine at home doesn't just lower your profit, it makes you lose money on almost every single coin, regardless of how long you run the machine. This is why nobody serious mines Bitcoin from a bedroom anymore. It's not a hobby business, it's an industrial one, and it only works if you can get electricity cheaper than your neighbor. There's also a second problem baked into Bitcoin's design, something called the halving. Every 4 years, the reward miners get for solving a block is cut in half. In 2024, it dropped from 6.25 Bitcoin per block to 3.125. Same machines, same electricity bill, half the coins produced. This is why mining costs roughly doubled overnight after the last halving. The network doesn't care about your costs. It only cares about maintaining scarcity. So mining isn't really owning a cryptocurrency in the way people imagine. It's running a manufacturing plant where your product's value depends on a market you don't control. Your input cost is electricity you can't negotiate down easily, and your output gets cut in half every 4 years by design. This is why the mining industry today looks less like curious individuals and more like publicly traded companies with access to industrial power contracts. The bedroom miner dream mostly died the moment electricity became the deciding factor. But mining isn't the only way people own a coin today. There's a second path, and it costs almost nothing to start. That's where things get a lot more interesting, and a lot riskier. If mining costs $50,000 and a warehouse, creating your own coin costs less than a coffee. On platforms like Pump.Fun, deploying a brand new cryptocurrency costs around 0.02 SOL, roughly $5 at current prices. You pick a name, a ticker symbol, upload an image, and within seconds, your coin exists on the blockchain and can be bought and sold by anyone. This is the part people don't expect. You are not required to write any code. You are not required to explain what your coin does. You are not even required to hold any of the supply yourself. Some platforms will pay you a small reward just for creating a coin that becomes popular, whether or not you personally hold a single token. So how does anyone make real money from this? Through something called a bonding curve. When a coin launches, its price rises automatically as more people buy it, following a built-in formula, not a real order book. Once enough people have bought in, and the coin's paper value crosses a certain point, on Pump.Fun that's $69,000, the platform automatically creates a real trading pool on an exchange called Raydium, seeding it with around $12,000 of actual liquidity. That $12,000 is important. That's the real money. Everything before that point was just people trading tokens back and forth on a formula, similar to the market cap illusion from earlier. The moment real liquidity gets added, actual buyers and sellers can trade at a stable price, and that's when a coin either survives or dies. Most don't survive. Out of the 11 million plus tokens created on Pump.Fun, the overwhelming majority never reach that liquidity threshold. They get created, a few people buy in early, the creator or early buyers sell, the price collapses, and the coin is abandoned within hours. This is the pattern people call a rug pull, though technically, a rug pull is when the creator planned the collapse from day one, while most coins simply die from lack of interest. If you want a coin that actually looks legitimate instead of a $5 experiment, the price goes up fast. Getting a custom smart contract built, a security audit done so buyers trust it won't have hidden exploits, real marketing, and a stable liquidity pool typically costs anywhere from $5,000 to $30,000. Serious projects aiming to be taken seriously by centralized exchanges spend $50,000 to over $100,000, sometimes more. So creating a coin has two completely different price tags depending on your goal. $5 if you're gambling on internet attention, tens of thousands of dollars if you're trying to build something that survives past the first week. Either way, here's the uncomfortable truth. The platform makes money regardless of whether your coin succeeds. Pump.fun takes a 1% fee on every single trade. Win or lose, pump or dump. The house always gets paid. The creator usually doesn't. Here's something that connects both mining and coin creation back to the same issue. Ownership in crypto is almost never spread out evenly, no matter what the white paper promises. In mining, this shows up as a handful of large companies controlling most of the network's computing power because only they can afford industrial electricity rates. A handful of mining pools process the overwhelming majority of all Bitcoin blocks today. The average person with a single machine at home contributes almost nothing to this number. In coin creation, this shows up differently, but leads to the same place. When a coin launches, the creator and early buyers typically hold a large percentage of the total supply before the public ever hears about the coin. When that coin gets attention and the price rises, those early holders, often called whales, are the ones with enough supply to actually cash out for real money. Everyone who buys in after the hype starts is essentially providing the liquidity that lets the whales sell. This is why you'll often see a coin's price spike dramatically right after launch, then crash within hours or days. That's not always a coordinated scam. Sometimes it's simply the natural result of concentrated ownership meeting new buyers. A small number of wallets holding a large percentage of supply will always have more power over the price than thousands of small buyers combined. This is also why owning a cryptocurrency doesn't mean what owning a stock means. When you own a share of a company, that company has real assets, real revenue, and legal obligations to shareholders. When you own a meme coin, you own a number in a database with no legal claim to anything. There's no annual report, no dividend, no vote at a shareholder meeting. Your ownership is only worth what the next buyer is willing to pay, and if there's no next buyer, it's worth nothing, regardless of how impressive your wallet balance looks. This isn't unique to crypto, by the way. Concentrated ownership deciding a market's price exists in real estate, in stocks, in art. But crypto makes it faster and more visible because a coin can go from creation to a $100 million market cap to zero, all within the same day. So let's bring this back to the actual question. What does owning a cryptocurrency get you, practically speaking? If you mine it, you own a manufacturing output. You've converted electricity and hardware into a digital asset, the same way a factory converts raw materials into a product. Your ownership is backed by the real cost you paid to create it, which is why Bitcoin mining costs act as a rough floor for its price. Miners generally won't sell below their production cost for long, because that means running the business at a loss. If you buy or create a coin, you own a claim on future buyers, nothing more. There's no factory cost backing it, no revenue behind it, no legal structure protecting you. Your entire ownership is a bet that someone else will want it more than you do, later at a higher price. This is the core difference people miss. Bitcoin's price has a cost-based floor because producing it is expensive. Most other coins have no floor at all because producing them costs almost nothing. This also explains why Bitcoin and meme coins get treated so differently by serious investors, even though both are technically cryptocurrency. One behaves more like a commodity with a real production cost. The other behaves more like a lottery ticket with a fancy interface. None of this means crypto ownership is worthless or a scam by default. Plenty of people have made real money, and plenty of legitimate projects exist with real teams and real use cases. But the economics only make sense once you separate the three very different things people lump under owning crypto: mining an asset with a real production cost, creating a token with essentially no production cost, and buying someone else's token hoping the price goes up. Three different businesses, three completely different risk levels, all wearing the same word: ownership. So back to the question from the start. Is owning a cryptocurrency a $5 hobby or a $50,000 business? The honest answer is both exist, and they're not the same thing at all. One is closer to running a small factory. The other is closer to buying a raffle ticket with better marketing. If you're someone thinking about getting into crypto, the real question to ask yourself isn't, how do I own a coin? It's, which of these three games am I actually playing? Are you paying for real production costs like a miner does? Are you creating a token and hoping attention turns into liquidity? Or are you buying someone else's token, hoping there's a bigger buyer coming after you? Knowing which game you're in is the difference between making an informed bet and mistaking a number on a screen for money in your pocket. If this helped you understand crypto ownership a little better, subscribe, because we break down exactly how these financial systems actually work every single week.